Hi, I'm Jon Siegel, and I am a partner and chief investment officer at Railfield. And Railfield is a multifamily owner and asset manager based here in the DC area. And one of the defining characteristics of our firm is that the three partners all came from Fannie Mae. So before we were entrepreneurs on the ownership side, we were lenders. One of my partners, Ken Bacon, ran multifamily at Fannie Mae. And my other partner, Todd Watkins, and I worked for him there. And so we think that we have expertise both in the property ownership side and also bring a lot of expertise on the debt side, which gives us a little bit of a competitive advantage. So debt, obviously, in its most basic form, is helpful when you're a borrower and an owner because it provides you with leverage where you can you can take your equity and make it spread it over more properties, and it also lowers your cost of capital. But in a more specific sense, as a borrower, you can use it to your advantage to improve the deals that you're going to buy and make yourself more competitive on more deals. So there are innumerable types of debt given that different property types and different structures, and having the knowledge to be able to structure a deal to either maximize the proceeds or lower the rate or give yourself flexibility makes your deals more attractive and ultimately increases the yield on your deals. Yeah, property type is enormous when it comes to borrowing. When I think of commercial real estate, there are obviously a number of different sectors within commercial real estate. Multifamily, which we specialize in, has the most efficient debt market because of the government-sponsored entities, Fannie Mae and Freddie Mac, along with HUD. And then the other property types don't have that, so they obviously have less liquidity in their markets. And then obviously the various property types have different dynamics going on at any one time. So it's oftentimes hard to borrow on an office building, depending on what's going on in the market, or on a hotel. And so property type is enormous. And within the property types, there's a lot of different subsectors where certain property sectors are within favor. So, in the multifamily space, maybe there's a time when people really love student housing, or when you talk about hotels, go back to COVID, obviously limited service hotels fared much better than full service. So property type is very important, both in a macro sense and a micro sense when you break it down and look at all the different factors in it. So when the pandemic hit, obviously, nobody knew what to do, and everything sort of stopped for a month or two. But once everybody got their feet under them and figured out sort of what things might look like going forward, the lending market actually became pretty robust. Now, when you talk about certain property types like a hotel or retail, those were very hard hit in the pandemic. And so there was really no money available in those sectors at the beginning. And, it's evolved over time. And certainly 2 years later, there's some. Office would probably be somewhere in the middle. In the multifamily space, we saw an incredible amount of growth in the business, and lending actually became probably more dynamic, and the market really accelerated. And so it actually became what we call a golden age of multifamily. So that lending market actually has gotten better. And then industrial is kind of the same thing, where the property type is in such favor that there's a lot of people looking to lend money on it. So very specific to the property types, but despite everybody's thought that when the pandemic hit that the lending market would be absolutely decimated, that didn't happen, and in many instances it actually has improved. Yeah, rates going up makes things a lot more complicated for borrowers, obviously. At its most basic point, obviously, it starts to increase your cost of borrowing, which reduces your cash flow. But it also has a lot of other impacts in the market that you have to take into account. As rates go up, first of all, potentially you can borrow less money. And then there's the impact that it has on valuations. And that's the thing that a lot of people are struggling with now. The 10-year Treasury is probably up 100 basis points in the last couple of months. And everybody's looking at that and saying, how's that going to impact values? We've seen in most property types, again, and specifically really in multifamily, interest rates cap rates at record lows. And as interest rates go up, you would think, that it's basically a math problem that if interest rates go up, well, it costs more to borrow, so therefore the prices are going to go down, but that has not happened. And so, so the big question that everybody's asking is how sustainable are the valuations that we have right now, given the rising interest rates? And, the conventional wisdom that we're seeing right now is really that there's so much money chasing deals that people are willing to accept lower returns. The question is how long, obviously, that will last. That's what we're seeing right now. We're still seeing, we're seeing interest rates go up. We're still seeing cap rates either going down or at best leveling off. It's still at record lows. And so the question becomes, how does that impact valuations going forward? Yeah, so for the rest of the year, I think that as we see interest rates go up, we're seeing a lot of people wondering what's going to happen in terms of valuations. So are valuations going to hold, or are they going to decrease? And that's probably the biggest impact that we've seen so far. I think that, again, the conventional wisdom is that things will probably stay the same. What we've seen, over the last couple of weeks, even where we sit right now in April, is that things are still very, very frothy. There's a lot of money chasing deals, and so we've seen prices hold, but we've seen things start to level off a little bit, and we've seen some people decide to take a step back and try to figure out what's going on. So as rates go up, what we've seen has been interest rates going up, but cap rates either staying low or in some cases declining. And what happens, mathematically, is it's hard to buy a property at a 3.25 cap and borrow money at a 4 cap. And so that's negative leverage. And so you have to basically expect that you're going to see an incredible amount of growth, especially on your top line over, say, your first year. So you have to go into the property and think, okay, I'm buying in a 3.5 cap and borrowing in a 4 cap. I can raise the NOI by 20% and then get it up to a 4 cap in the first year. That's a big assumption to make. We've seen rent growth in multifamily be like that, see that in some other property types. And so the question is, how long does that last? The other thing that we're looking at and wondering about right now is, as interest rates go up, what will happen to a lot of the players in the debt market? I'm old enough now to remember going back to the great financial crisis, and we saw the rise of the conduits going up in 2006, 2007, 2008. And when interest rates got to a certain place and the debt market got to a certain place, those people went away. And when those people go away, that means there's just less liquidity in the market. That's really, really important in multifamily, where traditionally you've seen most of the people borrowing money from the agencies, from Freddie Mac, Fannie Mae. And recently we've seen their market share go down significantly, and the rise of the debt funds. And debt funds tend to be private equity, hedge funds, other entities, and they oftentimes will borrow their money to lend you the money. And as their rates go up, at some point they're going to say, well, this doesn't make sense anymore. And so if that happens, that's going to have a really chilling effect on the market. So I don't think that's going to happen, anytime in the next 6 months, but that's probably something to keep an eye on going forward. So, how much are rates going to affect valuations, and also, how robust is the lending market going to be if rates keep going up as the year goes on? But probably be pretty steady, going through the end of the year, and we'll see what happens in the future. If you want to learn any more about how we approach debt, you can visit our website. It's railfieldrealty.com, and on there's a way to contact us. Feel free to reach out anytime. We're always happy to talk to everybody and try to share some of our insight as we navigate through what looks to be a pretty tricky market.